So again, I'm not talking about how the taxation system is good or bad, but the idea here is that you should always weigh how much selling now versus selling later would fetch you overall profits. Okay, the idea is to get the maximum after tax return in whatever way that you can. Okay. And also, if you know that whatever portfolio, whatever index, whatever benchmarking that you do in the real world as well, a lot of clients, they also want to see their after tax return. Okay. So, and that's, I think, the main thing, because if tax is 30%, you give me a lucrative 30% profit, and 30% goes to my tax, then I didn't get anything actually. Right? They also say that I'm saying that if my return is 10% and my tax is 30%, my after tax return is 10, 1 minus 0.3 is 7. So it also says that if my return is being taxed after tax return, then my risk is also being treated similarly. So I can say that my after tax standard deviation, if it was originally 12%, and if my tax is, let's say, 20%, so I can say that my after tax standard deviation would also be 12, 1 minus 0.2, which is 9.6. And that plays a very important role now. Why am I saying this? I'm saying this because everybody, and especially in your IPS, you say that I'm okay to take X% deviation, right? And they say in terms of after tax, obviously. So is it right to say that if I'm okay with plus minus 9.6% deviation after tax, obviously, then is it right to say that before tax I'm okay to take plus minus 12% deviation, right?
Yeah.
Want to re-explain?
No.
Right, so they say that when your IPS says that, okay, I want after tax return and I want after tax deviation is 9.6%, it means that before tax I can do a 12% deviation, which means from, let's say, 50, effectively I should have gone whatever 41.4 to 59.6, but I can now go from 48 till 62. Now, why this is important? Why this is important? Because a lot of times your IPS says that when the volatility, let's say, goes 10% plus minus, you should rebalance. You should rebalance the portfolio, right? And I hope you understand why rebalance is required, because if you started off with 60% equity and 40% bonds, and the market is performing well, then there is a high chance that this becomes 72, let's say, while this still keeps 40, assuming. So the weight of equity is actually 72 upon 72 plus 40. Is that correct?
Yeah.
Which is more than 60. Here it is 60% weight. So this weight is more than 60%. So they say that, and then they say, right, I'm okay with 10% deviation.
Yeah.
Which means that if my equity weight is 50 or 70, no need to rebalance. Anytime it breaches that, we should rebalance. And you know that every rebalance will cost me something. And the reason being, there will be transaction cost, buying and selling. Then there will also be taxes. involved, isn't it? For whatever securities that you're going to sell, if they're in profit, you will have to pay tax. And while buying and selling, you will have to pay the transaction cost. Are you okay
Yeah.
so far?
Yeah. With you.
I'm saying that we tend to have, again, rebalancing is important. Rebalancing is important, but we do not want to rebalance too frequently क्योंकि वो बहुत महंगा हो जाएगा फिर इन्वेस्टर के लिए, right?
Yes.
And then if you do too infrequent rebalancing, it just digresses away from the original idea too much. When I put an initial allocation of 60 and 40, there was some idea, right? Why am I putting a 60 as equity, 40 as bonds? There was some reason behind it. So I don't want to let them digress a lot that this becomes 80 and this becomes 20. Then my whole objective is lost. Right? So rebalancing is important, but too much rebalancing is not so good. So I'm saying my after tax things give me a leeway that if it was originally 9.6% and my before tax it then becomes 12%, so I would still not have to rebalance it frequently because I still have a little bit of more room for volatility. Understood the whole background around it?
Yes.
Right? So in a nutshell, the whole theory and my whole background from last 5 minutes is कि taxation, although it's bad, but in a way, this also is in a way good for us because when the taxations are high, my standard deviation also incorporates the tax, which gives me a little bit of flexibility on the overall deviation. So can I say to convert this back from 12 to 9.6 and whatnot, what we did was my deviation multiply 1 minus t. So is it right to say in a way that my after tax deviation will be equal to my pre-tax deviation upon 1 minus t?
Yeah.
Right?
Yep.
Look at this.
So it should be 36.5 and 43.5. Hello?
Tax exempt investor asset allocation calls for 40% investment in fixed income, 5% for a range of 35 to 45. Okay. If the fixed income returns are subject to 30% tax rate, that would be equivalent after tax. ठीक है. Is it right to say that effectively from a 40% investment, it gives me room for 5%, so it can be 35 to 45, right?
Yeah.
Now I want to understand if the tax bracket is 30%, how much this range would be. Is it right to say that before even solving this, is it right to say it will be little less than 35
Yes.
and it will be little more than 45?
Yeah.
Right? So whatever adjustment that we're going to do with the taxation, it is going to
Yeah.
increase my overall bandwidth.
Yep.
Is that okay?
Yeah.
Right? So this 5% deviation, if you do 5 divided by 1 minus 0.3, let's say 5 divided by 0.7, how much is value turn out to be?
It should be like something like 7.
7, right? So let's keep it 7 for now.
Yeah.
So they say originally was 40 and the deviation is 5. If the tax is 30%, my deviation now can be 7. While it was 5 before, when it is taxed at 30%, you can see that the deviation can now be 7%.
Okay.
So while it was 35 to 45 before, it will now be 34 and sorry, 33 and 47.
Okay.
Are you understanding what I'm saying? Right? So I'm
Just
saying
saying.
that I'm just keeping it 7%. 5
That,
divided by, huh?
why won't it be 3.5? Like, why is it 5 divided by, like, so you're saying basically, so 5 is already the after tax, is it?
The 5 is the, no, so the 5 is the target. So I'm saying before tax. I'm saying this is before tax. They say the original, look at this. Let's say there are no taxations. There are no taxations, though. So somebody would say, I have an investment with 40% and I'm okay to do a plus minus of 5, which translates to
Okay, okay.
35, 45. So far, so good. ठीक है. Now I'm trying to say and then think logically first कि अगर मेरे टैक्स 30% टैक्स लगने वाला है उसके ऊपर, so my
Yeah.
after tax rebalancing range would be little more than what I have before,
Yeah.
right? So if I do 5 divided by 0.7, it translates to 7% assuming, which means while initially I can do a plus minus of 5, now I can do a plus minus of 7. क्योंकि क्योंकि the point that I'm trying to make is कि a plus minus 7 will still be considered as a plus minus of 5 for the clients. A plus minus of 7 for me will still be called as plus minus of 7 for the plus minus of 5 for the clients, right?
Yeah.
And then this comes to 33 and then 47. Is that okay?
Yeah.
Sure about this? Can we proceed?
Yes.
Another thing is, they say that there are two ways to save the tax. There are two ways to save the tax. One is something that we just discussed. We call that as a tax loss harvesting. Something that we just discussed, that 100, 70, 30 rupees. On this 30% tax, so we saved 9 rupees. Right? So basically we deferred or we harvested. Think about this. There's a time value of money. Time value of money says that money in hand today is much more valuable than money in hand tomorrow.
Yeah.
So it just says that assuming it is going to be same 70 rupees even after 1 year or the end of next year. So why not get the money today, at least save 9 rupees. 9 rupees today is more beneficial than 9 rupees later.
Yeah.
This is called as tax loss harvesting. And the second one they talk about is strategic asset allocation. Now, what does this means? It's a simple thing. Something that we already discussed again. That if you are heavily taxed, you are in a higher tax bracket, then go for tax exempt investment. If you are in low tax bracket, go for taxable.
Yeah.
Okay? But you should always look at overall how much taxation that I'm going to get. Also, in terms of, let's say, stocks, if you think that dividends are less taxed than the capital appreciation, go for it. Go for investing into stocks that gives you heavy dividend. Okay. In India, let's say, I don't remember if I'm giving the right example, but I think SAIL, GAIL, NTPC.
Yeah,
They are those stocks that gives you dividend in 20 rupees, 25 rupees. ऐसे dividend देते हैं. ठीक है? 15 rupees, 17 rupees. They don't give you dividend in 1 or 2 rupees. So if my dividend is only taxed at 5%, I want to invest into such stocks where they are heavily, the capital appreciation is not too much, but the dividend is high. And I hope another one that gives most of the dividend is REITs.
Yeah.
Again, this is not a part of this topic, but you will read this somewhere. That REITs they do not give you a lot of capital appreciation, but they give you a regular dividend, kind of an income. So if you're looking for some investment that can give you regular source of income, REITs is one of the products. Okay. Are you able to relate all of those things somewhere if you have studied?
Yeah, I am.
Or maybe not covered everything. Okay.
No, read though I know. Read though.
By the way, out of curiosity, um, so I know that I have covered almost one book complete,
Yeah,
and from second, I have covered a few topics,
yeah,
and from fixed income, I'm just gonna cover in another 20 minutes, maybe 20, 25 minutes max. I'm gonna
yeah,
cover mostly इतना तो पढ़ा ही दूंगा कि that you will like fixed income, it will not look bad to you. So
yeah.
I'm saying apart from that, how does your preparation look like?
So I finished portfolio management, which is I think that book 5, and I finished private markets pathways, and I finished ethics.
So in general, is it after today's session, do you think that you would have covered around 70%?
Yes, 70%.
You will have your exam on 15th of August.
Yes, 16th.
Okay. So they say, I'm almost towards the end of this topic.
Yeah.
They say that how are you adjusting your asset allocation? Adjusting asset allocation. So there are two reasons of doing it. One is strategic, another one is tactical. We talked about this, that tactical is basically short term and this is long term. Now think about this. If you are changing your asset allocation strategically, which means long term, what could have happened? Maybe change in goals, right? Because that represents my ideology.
Yeah.
Maybe, and trust me, I have seen this a lot because I have studied this. तो मैं ये सब अपने घर में भी ऑब्जर्व करता हूँ. While my dad used to talk about that we should invest into this, we should invest into that, when he was when he was in his 50s, 40s and 50s, my dad is telling from last 2 weeks, हमको सब समेट ले, सब समेट ले, सब बेच, सब खत्म कर, सब खत्म कर. अरे what is going on? मेरे को समझ नहीं आ रहा, मुझे को समझ नहीं आ रहा, सब बेच के सब खत्म. अरे आपको क्यों समझ रहा है? मैं बैठा हूँ ना, मैं देख लूंगा. But now his goal is to preserve. He is not, again, he is 70 now. So at the age of 70, you can't expect a lot from him.
Yeah.
Right? But then I can clearly see the change in the mindset of how he used to think before versus पहले वो कोई भी चीज के लिए अगर 1 लाख किसी ने एक्स्ट्रा मांगा तो he's just gonna fight. भाई बोलते ठीक है यार, शांति दे रहा तो दे दे उसको, वो नहीं मानेगा तो दे दे उसको पैसा. ठीक है. So I'm saying that there are situations behaviorally which made you change your strategic investment, where your change of goals, or maybe you were thinking about pursuing something. Let's say we talked about campaigning, and you were investing something that, okay, I want to do this, and later you realize that you don't want to do this anymore, right? So in that case, you can change your allocation. Another one is change of constraints. What does this mean? Initially, you said that I would be buying a new car in 2 years. I would be buying a new car in 2 years, which means that I would require 20, 30 lakhs. So do not invest into long-term investment. Invest in something that can fetch me 20, 30 lakhs in 2 years. But now you don't want to buy a car, right? Or maybe another thing is you thought that, your savings is only 30,000, but your luck was shining and then you got into another job which is around 2x of your original salary. So your savings are now increasing. So you are okay to invest more aggressively somewhere. It's the other way around as well. Okay. Or maybe another one is you thought that whatever investment that you did was normal, right? That you are in your 30s and then you thought that you would retire in 60 and then take it from there. But then some illness happened and you had to retire at 35 or maybe at 40. Again, whatever that you thought initially is going to change, so that will also change, right? Another one is belief. As I said, there are a couple of factors here. One thing is you are a lot into astrology,
Uh-huh.
and you are looking at all of these planets and all, and you think that another 6 months, another 2, 3 years is not going to be good for India. So you don't want to invest aggressively into anything, right? You heard about Baba Wango, and you thought that there is tsunami that's going to come and hit the US markets, and you think that whatever he says happens. So it's your belief that you don't want to invest into something. So by that I'm trying to say, in terms of macroeconomic, it is your belief. I'm not saying that that's going to happen, not happen. You are doing it pre-hand, right? So if your belief system, or let's say I give you another example somewhere else where I said that okay, your friend or your relative met an accident because he was drunk, and then you said that okay, I don't want to invest into these kind of investments at all. So that's what that I don't like it, right? So a change in the belief would also bring a lot of change. In terms of tactical, if you look at it, tactical is first of all there has to be some kind of objective.
Yeah.
Right? Why do you want to move away investments for short term? And one thing that could be tested somewhere, that the strategy that you're going to put,
Yeah.
you should have. I don't know whether I'm going to have to look at it, whether they use the word guarantee or not. But the idea is that unless you have a surety that in whatever tactical allocation that you're trying to do will fetch you good returns, don't do it. Don't do it. Acha, let me just read this through. It says the objective of TAA, which is tactical asset allocation, is to increase the risk adjusted return by exploiting these short term opportunities. It should be noted that this strategy assumes short term returns are predictable. This is very important. If I think कि डीमार्ट का आईपीओ आ रहा है and I think कि डीमार्ट के आईपीओ में there's a sure shot you can get the money, good money, because this is anyways undervalued, go for it. But आईपीओ तो एलआईसी का भी आया था.
Yeah.
Right? And while everybody was aggressive, and one of my cousins said कि LIC में if you are a policy holder, they will give maybe one lot, but they'll give everybody a lot. So whatever money that you have, you invest all of it. Right? Even I was not very proponent of it, but I also invested, and then it opened at a discount. In fact, for a few years. Right? They opened the IPO at 900 or 800 something, and then it immediately went down to 700, 600. And it took 1 to 2 years to come back to 900. So the idea here is that if you're doing something tactically, you should be sure that whatever investment that you are doing has to be surely is predictable and you can get the return out of it. That's how you should go about this. And also, you should also compare. Let's say you are doing tactically for 3 months.
Yeah.
Then you should also inspect or evaluate how my SSA would have given me return, which is strategic asset allocation versus TA. Right? You should always do some kind of an attribution analysis.
Yeah.
Just to ensure that whatever I'm doing, do I know what I'm doing, or I'm just going by the hunch. Right? Also, when you look at tactical asset allocation, you also need to ensure, or you also need to evaluate when you are taking away money from strategic asset allocation, assuming you are investing into fixed income and you saw an opportunity in small cap equity, right? So I'm saying that you will have to sell your FI, pay transaction cost, pay tax if there is any, then pay transaction cost again on the equity, and then you wait and then you sell the equity, again transaction cost, and then on the profits you again pay the tax, and then again you will do the transaction cost on fixed income,
Yeah.
and then again you come back to your original allocation. When you do all of those things, is it going to give you return which is much more than what you were getting already from fixed income?
No.
Hello, it could be it is saying you need to evaluate that part,
Hmm.
right? So I'm saying maybe the returns are too they're too good, and obviously that's the reason people go for TAA. So I'm saying it could happen, but it's just that you need to evaluate if that's something that's going to happen for real or not. Okay. And then they say while doing the TAA, tactical asset allocation, some of the sentiment that you can use is, one thing they talk about is margin borrowing.
Mm-hmm.
It doesn't require any calculation, but it just want to give you an idea that if my margin borrowing is increasing, right? Margin basically means kind of loan.
Yeah.
Borrowing basically means borrowing. So if you are taking a loan, and if everybody is taking a loan, you can imagine that they are speculating that the market is going to perform well, right?
Hmm.
So if
Yeah.
margin borrowing is increasing, it's kind of a positive sentiment. If you have a short interest, it is kind of a opposite. It is a, if this is increasing, this is a negative impact. And third is, if the volatility is increasing, it's again a negative impact, right? Because if VIX is increasing, it's kind of a fear index. Why am I telling you these things? I'm telling you these things because when you are investing tactically, it clearly
Hmm.
means that you want to invest for a short term, right? So it is important that you look at how the market is looking, how the market is perceiving, how people are perceiving the overall markets, right? And you would see that in last 2 weeks, last 3 weeks, you don't see anything good, you don't see anything bad happening, yet the market is going down,
Yeah.
right? And the reason is very simple, that how people are perceiving at our economic, jabki the interest rates have reduced a lot. You can see that, right?
Mm-hmm.
They cut the repo rate by 50 bips, I guess. And then
Mm-hmm.
everybody says that if the interest rates decreases, the market sentiment is positive, the market is doing great, the market is doing good, and you should aggressively invest.
Yeah.
Right? So this is what a general theory says. But then what's happening in the real world is still the opposite. So even though they reduce the interest rate, it is not able to increase the consumption in a lot of ways, because you want to understand how people are perceiving the markets.
Hmm.
So I'm saying when you do this kind of tactical allocation, sometimes these information will sound very useful. Okay. Lastly is you should always look at the behavioral biases. I think these things are covered somewhere else. Do you
Yeah.
have a behavioral finance somewhere?
No, like I said, I didn't see it this time around. I remember last time it was there, but it's just not there this time.
Okay. So in this they covered a few things, and I'll give you a quick overview. One is loss aversion.
Yeah.
Another one is illusion of control. Third one is mental accounting. Fourth one is representative bias. Another one is availability bias. And then in availability, they talk about familiarity and hope. And I think that's it. Yeah, that's it. Right? So let me just quickly cover these things and then we'll be done with this topic. In terms of loss aversion, everybody understand that while we say that we are risk taker or maybe we are risk averse, We are actually not risk averse or risk takers. We are actually loss averse. So they say that there is a standard something that you study overall in CFA versus a behavioral finance, right? So behavioral finance talks about the traditional finance talks about what you should do. Traditional finance talks about what you should do, while behavioral finance talks about what you actually do. It's like this: early to bed, early to rise makes somebody happy and wise. It's something that people say and you should do. But Netflix का वो episode कौन छोड़ेगा रात को? Right? So this is something that what we do. So loss aversion talks about that although we say that we are okay to take risk and we are okay to take loss as well, we say it, but effectively nobody wants to take loss while they are okay to take all the profit. So we say that on a 10% increase, if you are happy, on a 10% reduction, you should be sad. This is traditional finance.
Yeah.
But behavioral finance says on a 10% increase, you are happy. On a 10% reduction, you are sad. This is traditional finance. So sorry, this is traditional finance. This is behavioral finance. Okay. So they say that people don't want to have loss and they're averse to loss. This is the real thing that happens. And risk aversion is a concept of traditional finance because it just looks at the volatility as equally. That happiness and sadness, they both weigh the same. Make sense?
Makes sense.
Check it. Illusion of control, the name explains. You think you know it, you think you can do it, right? And you believe that you know better than anybody else, so you have a control. Whatever returns that you get is because of your expertise and your skill set. That's the illusion of control. Okay. One of the points that come in illusion of control is superiority complex. Right? Maybe managing a team and you created a product and you know the in and out of the product. You punch some numbers in there and then you got some results and then you invested into that and you said, yeah, I know how this is working. I know. The basic thing that talks about is I know. That's your illusion, where you think that the market is moving because of you and your decisions. There could be several other factors that is happening in the background. Okay. Mental accounting. Mental accounting just talks about that how do you perceive your true money. Now, what does this mean? Suppose you got 100 rupees a salary.
Yeah.
Your expenditure is only 80. So you're left out with 20 rupees savings. And that's not good enough. But you invested into something, or not invested, maybe you bought something, right? Let's say you bought a TV worth rupees 20 or 30. And there is some malfunction that happens, or maybe kuch to aisa hua that they refunded your money and you got the TV as well. So in a way, while you thought that you will be spending 30 rupees, your 30 rupees is saved. Right? Technically, this 30 should get added to 20. It just increased your savings, it's a good thing. But you will spend 30 somewhere else. And you would think कि अरे वो तो मैंने already खर्च कर दिया था ना, ये तो जबरदस्ती का वापस आ गया तो ठीक है, let's just spend. Right? While you treat your money from a different mindsets. It is still your money. This 20 rupees saving is still your money. 30 rupees is still savings and still your money. But you treated these two money differently. And why you thought that 30 rupees तो extra free का आ गया. मैं टीवी खरीदा था, टीवी भी मिल गया और पैसा वापस भी आ गया, तो फ्री का पैसा है. फ्री का पैसा खर्च कर दो. Do we do that?
We do that.
I do it a lot.
Yeah.
I do it a lot. So my parents tell me that I don't save at all. I don't save. So I just said कि अरे मैंने वहां पे डाला था, उधर से जीएसटी आया था तो मैंने एक चीज और खरीद ली. जीएसटी अगर आएगा तो सेविंग्स हो गई ना वो. लेकिन मैं सोचता अरे अभी मैं तो जीएसटी नहीं भरता तो पैसा नहीं आता. जीएसटी आ गया है तो 20,000 बचा तो 20,000 रुपये कुछ और खर्च कर दो ना. Effectively, that's our problem, our behavioral biases, that we look at our money in two different things while we do not look at overall money at a single source of money.
Yeah.
Another one is representative bias, right? They say that, or we sometimes we call it as a recency bias. What does it say? It just says that something that is recently happened creates an impact on you. Right? So you give more importance to the recent data than the old data. But you can imagine that the recent data is not the best estimator, or maybe recent data could be just a one-off case, or maybe recent data is not, or maybe the sample is incorrect. But then again, our behavioral biases says that we looked at the recent data. If something has happened, think about this. If somebody told you that he earned 5 lakh rupees in 1 week, so it gives you a feeling कि अरे उसने 5 लाख रुपए कमा लिए एक हफ्ते में, मैं क्यों नहीं कमा सकता. But maybe in his whole life he just earned those 5 lakhs and then probably he just lost 50 lakhs somewhere else.
Sure.
Right? That's your representative bias. So it's very important that you have a strong governance and then you look at overall bigger time period to understand if it is a bias or something has happened for true. So I'm saying availability bias is very much in line with, well, it's very much similar to representative bias. It's just that the representative bias looks at what you saw in the recent time period.
Yeah.
And availability bias talks about what is easy to recall in your brain.
Okay.
Easy to recall. What is most available in your brain? Right? And think about this. Somebody who lost his, a family member in COVID. You talk about COVID, you just touch a topic of COVID and just start speaking about those days. Right? My grandmom used to talk about all these 1947, and sometimes my parents also talk about it. अरे उस समय siren बजता था, light बंद करते थे, right? They always talk about these things.
Yeah.
Because it is so much in their brain that even if they're sleeping, you talk about them, they will be able to speak. Okay? So familiarity bias is kind of overshoot of availability bias, where this still speaks the same thing, that your decisions will have a bias because you are more familiar with that situation. So you will think that situation at a base or at a par, and then you do every referencing with respect to that base. Right? So because you are more familiar. And then the home bias, again, I think this is something which everybody does, right? We want to invest in domestic securities, and something that you're very, you think that that's home. You know about your country. You have more information about the securities, the domestic markets, the politics.
Sorry, what is it? Familiarity and
home bias. Home bias.
Home bias.
So home bias says that, think about this. So you want to invest more into domestic securities because you believe that you know what is happening in the country. You are familiarized. You know about the companies in which you invest in. You know the dynamics of the country, and you believe that at least जो मुझे आता है, जो मुझे पता है, मैं उसी में करना चाहता हूँ. Maybe investing into Africa can give you more returns, but probably you don't want to invest into Africa. Right? So traditional finance says that you look at the risk-adjusted return. If risk-adjusted return tells you that investing in Africa is a good option, then go for it. But the home bias says no. कम रिटर्न चलेगा, बट मुझे ऐसी जगह करना है जहां पे मुझे पता हो वहां के बारे में. Right? So you don't look at those securities and those investment independently. Rather, you have a bias, and hence it is a kind of a behavioral bias. Is that okay? I think we are done. So let's just take maybe
Yeah.
5 minutes break.
Yeah.
Okay, and then let's just regroup at 8:25, and
Yeah.
then we'll start with the fixed income. Meanwhile, I'll just open the book as well. You know what? Everybody takes fixed income very lightly.
No, no, I
Uh,
don't. I don't understand it much, so that's why I don't.
but let me tell you, अगर if you've cleared your CFA level 1, level 2, so level 3 का तो fixed income is easy peasy.
Yeah. Yeah. I know it's.
But
I
let me tell
always
you,
found it a bit
go
daunting
ahead.
because it's something. No, it's. I found it a bit daunting because it's something that I don't do every day. Like things that I do every day, I'm able to like obviously relate to it and grasp it much quicker. So a lot of like portfolio construction, asset management, equity. Thankfully, this time that elective subject is private markets. All of that, like somehow, like I'm able to understand and grasp quicker. Just fixed income a bit challenging because I don't see it that often.
But let me tell you, I spent half of my career, more than half of my career in fixed income.
Right. When you were in
But fixed
JP,
income, yeah, yeah. But
right?
fixed income is still difficult, right? So knowing the concepts and saying, "Okay, ठीक है, interested," but again, when you solve the questions,
Yeah.
when you understand this, it is not that easy.
Yeah.
But level 1 and level 2 is much more difficult. Level 3 is still okay, I will tell you. Okay, so when
Yeah.
I'm going to teach you for an hour, you would feel that "अच्छा, ठीक है, it's not that bad." But usually it is difficult. And I can tell you, fixed income can be a deal breaker at least for level 1. You don't know fixed income,
Yeah.
there's a
Yeah.
high chance that you will not clear the exam. Okay. But when it comes to fixed income, um, although we say that we don't talk about this, but ironically, fixed income has a much bigger universe than equities.
Yeah.
Much, much. Equity is just a small portion. It's an ocean. In your fixed income, you can have public fixed income, and then you can also have non-public, right? Because you have bonds, and then you have
Yeah.
money market instruments. Right? In non-public, you have loans, and then you have private placements. Think about this, right? We take loan day in, day out, and
Yeah.
then we still don't realize it's a part of fixed income.
Yeah.
At the end of the day, you are mortgaging your property and you are paying some EMIs.
Yeah.
So your EMIs kind of their coupon payments in a way,
Yeah.
right? And then you're paying off your whole of loans, and then there are private placements. Obviously, we understand that bonds are something that are being traded in the market, and then the money market instruments are usually called as short-term instruments. But
Yeah.
before really getting into this, it is important to understand how my fixed income is going to add a value overall to my asset allocation, because we talked about that we want to do asset allocation strategically, and then we also understand for conservative approaches, we want to invest more of fixed income in our
Mm.
overall portfolio. So
Mm.
how does my fixed income effectively useful in our overall portfolio allocation? So first one that we talk about is diversification. Diversification.
Mm.
I hope we know that my equities and my fixed income have a low correlation. Okay.
Yeah.
If you look at it historically, although theoretically you can say that they are negatively correlated, theoretically, but practically, what I've seen myself is it lies somewhere from around 0.5 to around 0.4. something that I've seen when I created the correlation chart. So it's somewhere a reach is there, but then I would still say that's the reason I'm using the word low correlation. I'm not using the word negative or positive. Even low correlation helps me a lot because unless it is high correlation, it is a value add to my portfolio. Right? Even in diversification, I can still bifurcate this within EM versus DM. Right? And within EM versus DM, I can always segregate between IG and HY. So you can imagine my EM, a combination of EM plus HY is the most deadly combination.
Yeah.
But a combination of DM versus IG is the safest in a way.
Yeah. Yeah.
Right? So emerging markets have more risky than the developed markets, and IGs are more safer than the HY markets.
Yeah.
High yield security. Yeah. So, but overall, if you look at fixed income, it just adds a value in a way because the allocation with respect to fixed income is equities and it has a low correlation. Another advantage of using the fixed income is the regular cash flows. While we can also say that dividends are also a kind of regular cash flows, but then everybody knows that dividends are voluntary, right? The company under no obligation is to pay the dividends. While if you have unless you have a zero coupon bond which does not pay anything, the usual scenario is that you will have some kind of a regular cash flow. I'm not using the word fixed regular cash flow. I'm just using the word regular cash flow because your securities can be fixed versus floating. But the idea is that you will have some kind of cash flows. Third one that I talk about is inflation hedge. Obviously, not every security. When I say security, I'm referring to bonds only. Not every bond is inflation hedge, but they also say that there are products in the market which helps you create a hedge in the inflation. Now, let me tell you a few things. There are three types of products. One thing is fixed. But before that, let me ask you, if the coupon is 5% and my bond price is being traded at 100, 95, and 105, what will be the coupon in the three scenarios?
5%.
This one. Okay, how about this?
I mean, if the par value is 100, then it's just 5 across.
I'm saying the current bond is being traded at 95. What will be the coupon?
5.
This one?
5.
This is a classic interview question that I always ask. And 99% people, they goof up in this, unless they are CFA level 1, level 2, obviously, because it is being taught to you, right? So every time they say that, Ankur, this is 5 and this is 5% of 95. Which is incorrect, right? And the reason why I'm saying is coupon is always pays on par. Always.
Yeah.
Okay. And par is usually a multiple of 10 or 100.
Yeah.
Okay. So if that concept is right, let's just talk about that. You have fixed where you have a coupon of 5%. So no matter where the market moves, you will always be given 5% of par 100, which is 5% throughout. Another one is floating. In your floating, the rate changes on par 100. So it could be live. Let's say it is LIBOR, right? So in this one, if the rate is 5%, you will get 5 rupees. If it is 6%, you will get 6 rupees. So I'm saying if the market is performing well, if the market is doing great, and the interest rates are going higher, then in a way your return or your cash flow would be higher. Okay. There is another one which is called as inflation linked bonds. This is fixed coupon bond. This is floating rate bond. We call that as a FRN, right? Floating rate notes, they call it most of the time. Another one is inflation hedge bonds.
Yeah.
What it does is, in that the coupon rate is fixed. Let's say 5%. But the par itself adjusts with respect to market. Right? So what does that mean? What does that mean? Is you start off with 100, but then the par adjusted to 105. If the par adjusts to 105, your 5% on 105 will be higher than 5 rupees. Okay? One of the examples of this is TIPS.
Yeah.
Treasury inflation protected securities.
Yeah.
Okay? So in this, oh, they don't show. Okay. So I have a previous version of the books where they talk about, they give you a table that where they say that in a fixed type, what is protected and what is not protected. So what they say is that in the same thing that I've explained, that when it comes to par, only inflation hedge is the product in which the par is protected to inflation, which means it keeps on increasing with the inflation.
Yeah.
Right? While in others, the par is still constant.
Yeah.
And when it comes to coupon, it is the floating rate bonds. Coupons of floating rate bonds in a kind of protected. Is that okay?
Yeah.
I'm good.
Okay.
Let me just. Okay, look at this. I'm just सोच रहा था कुछ गलत तो नहीं कर रहा हूँ मैं. I'm just reading it through. So it says if the purchase inflation rate is 5%, the par increases by 5%, and the new value will be 1.05 million. ठीक है?
Yeah.
Something that is inflation linked. Okay, fair enough. All right, let's proceed then. They talk about that what are the different kind of fixed income products that you see in the market. And they say that different kind of products that you see are one is that you have liability based mandates. The name explains that your objective is to match something with respect to liability. Okay? So your mandate is to meet the liability, and to meet the liability, what are the different products that can you have? So they say one thing that you have is cash flow matching. Another one is duration matching. Third one is contingent immunization. Fourth one is horizon matching. Right? And then they also say that you could also have some kind of total return mandates. In which you could have pure indexing. You can have enhanced indexing. And then you can have active management. Let's just look at each one of them one by one.
Just 1 second. I'll just so this cash flow matching, duration matching, contingent horizon matching.
So on a liability based, sorry.
Portfolio. Okay.
Right. On a liability based benchmarks, you have cash flow matching, duration matching, contingent immunization, and horizon matching. In terms of total return mandates, you have pure indexing, enhanced indexing, and then active matching.
Yeah.
Okay. Okay. Let's look at one by one. One is cash flow matching. Think about this. Okay. Let's say you have some kind of EMI. You have some kind of EMI of 40,000.
Yeah.
And you have a flat that you have put on rent that has a rent of 40,000. Isn't it the kind of cash flow matching?
Yeah.
So kind of you have met your liability. You have done a kind of cash flow matching where one source of income actually offsets or equals to the cash flow outflow that I have, and it exactly matches, and my liability is being met without any further differences.
Yeah.
Right. So I gave you an example of rent and EMI, but I'm saying that you invest in some kind of instruments so that the coupon payment that you receive, from those products should be equal to the liability due for that period.
Yeah, makes
Right?
sense.
So that you do you do a one-to-one mapping of cash flows and you can meet the liability. Another one is duration matching. Very, very popular in the industry. Very, very popular. What does duration matching means? That think about this, the cash flow matching is kind of very bespoke in a way that if something changes a little bit, maybe the coupon that you are receiving versus the liability that you have, then you have a lot of mismatch. And you really don't have to, and investing in such kind of products where you have exact matching, you might not be able to exploit all the opportunities, right? And the portfolio has a lot of different liabilities and different payments come in different time.
No, can you repeat this? Sorry, can you repeat this?
Yeah, I'm saying in a cash flow matching,
Huh.
where you have one-to-one matching, right? In that, usually when you have one asset and pretty much one liability, it's easy.
Yes.
But in usual scenarios in the world, you do not invest into just one product, you have multiple products. And let's say you invested into multiple bonds, and every bond has a different specification. We understand that. One bond is 10 years, another one is 3-year bond. One has a coupon frequency of semi-annuals, another one has a annual, right? And the liabilities are also very differently. When such things happen, cash flow matching is not very useful. We go for duration matching. Right? So what does it say? And then we does a lot that we look at, although we were more into benchmarking. So we look at the benchmark, and then we create a strategy, and we want to ensure that the strategy has a similar duration to the benchmark. Although this is what we do in the job profile. But the idea here is if the duration matches with my liability, since these are liability benchmarks. So what we do here is we do a kind of indexing. So we create benchmarks. So we want to ensure that whatever strategy that we create over the benchmark, it should be in line with the benchmark so that the tracking error is low, etc. We do a lot of different things in the real job. But the idea in this fixed income topic is a duration matching, which says that if you have a liability which has a duration of 4.5 years, and you have assets that also has a liability that also has a duration of, let's say, 4.48 or 4.5 to be precise.
Yeah.
It is called as duration matching, because then I would know on different sets of liabilities and on different sets of assets, pretty much I might receive amount from different sources and I might have to pay amount to different sources. But pretty much since my duration is same or similar, my cash flows would still be pretty much similar. So basically, this looks at a broad term. This looks at a broad term that if I have multiple liabilities over multiple periods, it is very difficult for me to match each and every liability.
Yeah.
And then invest in different schemes so that it meets those liabilities every single time. It is difficult. So when you have a portfolio which is for a long term, the best idea is that you match the duration and somehow it will take care of it in the meantime. Is that okay? Another best advantage is when you have a very short term period, then cash flow matching makes much sense. As I said, 40,000 versus 40,000 as liability, it can be met. But when you have a long term and there is a probability that the interest rates could change, and there's a chance that in a 10-year horizon, the interest rates could change. The best way to go about that is the duration matching, so that in case my liability increases when the interest rates goes down, my asset value also increases when interest rates goes down.
Right.
Yeah, because the idea is that I want to meet my liabilities. But if the interest rate goes down and my present value of liabilities will be too high then, and I still have the same asset, or the asset doesn't increase, I have to fund it externally, which I don't want. So if I'm going to do a duration matching, any changes in the interest rate will be taken care of by both asset and liabilities equally. Is that
Makes
okay?
sense. Yeah.
Another one that they talk about is contingent immunization. The word immunization is like preserve. Immunize कर लिया, immune कर लिया, बचा लिया. The word C represents contingent, which means conditional. So they say, let's say your asset is 100 and your present value of liability is 80, right? So you preserve your 80, which means my asset equal to present value of liability, and you can play around with 20. Right? So why am I calling it? So why am I calling it as a contingent? I'm saying, first of all, if my asset is equal to present value of liabilities, or if the asset is less than present value of liabilities, there is no concept of contingent immunization. No concept. And the reason is you can't play around. All you need to you preserve the asset in such a way that it meets the liabilities. Is that okay?
Yeah.
But in situations where your asset is more than the present value of liabilities, in that scenarios, you can play around with this 20 so that you can earn some extra money. Now the advantages are two words. First is if this 20 becomes 25, right? You still are meeting the liabilities. So that's like your overfunded kind of a status. And then if it reduces, so you invest your 20 rupees and then you thought that it will increase to 25, but let's say it just goes away, it just reduces to 10, right? So when it reduces, you actually do not wait to it to become zero, or you do not wait it to erode your original asset. You do not wait, you immediately sell off everything and you preserve. Right? So the idea here is that you want to do some kind of active management, but not at a cost of eroding your current asset. You want to play around with the extra money, but up to a point where you think that the extra money is giving the extra return. If your active return is negative, or you think that your strategy is not working at all, do not wait to it. Do not wait your surplus. This is your surplus, right?
Yeah.
Do not wait for your surplus to become zero. Rather, sell it then and there and preserve, at least if we still have 10, we still have 90, which is more than the present value of liabilities. We are still good.
Yeah.
Is that okay?
Yeah.
Okay. And the last one that you would see is horizon matching. Right? So this is a combination of these two basically. This is like cash flow matching plus duration matching. You know the reason and you know the objective of duration matching. How does it work and why do it work? But then when duration matching was a good enough strategy, why did I think about horizon matching?
Yeah.
So it's just like adding another layer to it, which ensures that all the short-term returns, specifically the liabilities, are being met 100%. So when I said that, then you have when I say that you have a duration matching, it is not necessarily the case that if you had the liability duration is 4.5, the asset duration will always be 4.5. It is difficult to achieve.
Yeah.
Right? Because you are investing into so many different products. So think about this as a portfolio, right? So in a portfolio, you have 5 securities: A, B, C, D, and E. This has a duration of 2. This duration of 2.5. This is 7. This is 10. This is 15. And then you have some weight: 20%, 30%, 5%, 15%,
Right.
10%. So the effective duration of the portfolio will be the weighted average number of these numbers.
Correct.
Right? So let's say, and now think about this: how difficult it is to exactly match 4.5. It's very difficult, right? There's no hit and try. So
Correct.
I'm saying sometimes it is not very, not very practical to really match exactly your duration. So when you think that your duration is pretty much close to my overall liability duration, in that case, you can also do some kind of a cash flow matching so that your liabilities are being met 100%.
Hmm.
Right? Obviously, this, needless to say, this becomes the most complex.
Mm-hmm.
This is the
So
least
wait,
complex.
horizon matching is a combination of duration matching and cash flow matching, is it?
Yeah.
Okay.
Is that okay?
Got it. Yes.
Okay. So even they don't have another table. I was looking. So in another table there was there in one of my book, and then it just says the same thing, that in the initial funding, this requires the most initial funding. You can imagine why. Because in this, I want my assets to be much more than the present value of liabilities, isn't it?
Hmm.
And in contingent immunization, I need the most money upfront, because first, if my liability is 80, I'm putting an asset of 100, right?
Yeah.
While in terms of duration matching, it is the lowest. You know why? Because you can always play around. Why am I saying this? So the duration of a liability is, let's say, 3.
Huh.
Don't you think that you can have a 10-year bond that has a duration of 10, and then you give 30% weight to this, that will still bring you a kind of
Yeah.
a duration?
Yeah. Yeah.
But then that doesn't solve my purpose in a way. That was the reason we went to horizon matching. But the idea is that in terms of duration, when it comes to duration, I'm not going to look at my individual liabilities and individual assets.
Yeah.
I'm looking at it at a broad level if it matches the duration. So there could be, so there are things that I don't want to invest now. I can invest, or maybe I can invest into products that can give me returns few days later, right?
Yeah.
And you can also imagine that the cash flow matching would require again more cash because you want to meet even the short-term liability. So even you require investment in such a product that can give you returns immediately. Is that okay?
Yeah.
Now, another thing is when it comes to total return mandate. In total return mandate, so they say that you can have some kind of a active return if you want, but it all depends on what is the objective of your client. And let me tell you, in the real world, there were instances where a lot of clients came back to us saying that our objective is to minimize a tracking error.
Okay.
Right? So create something. Obviously, we want to have, look, the fixed income indexes are very broad. And I'll give you another reason in another 5-10 minutes that why do we have very broad indexes in the standard fixed income index could have 2,000 to 3,000 securities. Right? You want to check GBI, JP Morgan GBI index, global benchmark index. You want to check Jackie, JP Morgan asset credit index. And you can check aggregate indexes. So you would realize that the universe or the parent industrial indexes has more than 1,500 securities. Right?
Yeah.
So replicability is a bigger issue in fixed income. And I will talk about this in a while when I'm going to talk about off the and on the shelf securities. But coming back to the original thing, that every investor has a different objective as to what do they want to achieve. Do they want to have an active return and avoid the risk overall, or do they want an active risk and the lower of the active risk, or the lower of the active share? There are different terms, right, that they can use. So they say when it comes to pure indexing specifically talks about that you want to digress the minimum. Digress minimum. What does this mean? You are doing kind of one-to-one mapping. Right?
Okay.
Basically, it just targets zero active return and risk. Now you might ask me that Ankur, अगर pure indexing ही करना है तो करना ही क्यों है? Right? If I'm looking at a zero active return and risk, what exactly am I doing? But think about this: am I not replicating? So think about this: can you invest into Nifty 50?
You can
How?
buy the index, right?
By the index, okay. So okay, one thing is that you want to invest into index, or maybe you want to invest, you can invest via derivatives,
Right.
right? And a lot of 75. But I'm saying, isn't that possible that you buy all the 50 stocks
Yeah.
in the same proportion?
Yeah.
Maybe they have a shares of 1,000, but it overall carries 5%.
Yeah.
So you just buy in such a way that your weight in your portfolio is just 5%. Right? In that way, whatever you did is actually pure index. Right? Where your portfolio is going to give me return, which is very similar to your benchmark. And then once you do the pure indexing, then what did you do? What did you do? You actually used the same securities but in a smaller proportion. Is that okay? So what I'm saying is, some of the time the client comes in and say your benchmark has 2,000 securities,
Yeah.
but I am looking for 500 securities, right? That still tracks the performance of my benchmark. Are you getting it? So rather than, because let me tell you, even practically, it is not possible. Practically, it is not possible to replicate every single bond.
I see.
Some of the bonds that went to the index when they were on the run are now become illiquid.
Yeah.
Replicating means that you are buying that bond from the market and it is not available. So pure indexing plays a major role where you are trying to replicate the performance of the benchmark with a lesser number of securities that are liquid. Right? The enhanced indexing, you can imagine, where you are still targeting your benchmark in terms of your duration, let's say, but you are digressing a little bit in terms of the returns. So while you want this is what we do most of the time, even in JP Morgan. So whatever strategy that we build, we try to.
Sorry, what is enhanced indexing? Sorry.
Enhanced indexing. Enhanced indexing. So in enhanced indexing, I'm saying you are still doing the same, but you are not completely replicating. You are replicating mostly. So I'm saying if the duration of the benchmark is 5, I'm okay to have 4.95.
Yeah. Makes sense.
Right. So I'm kind of replicating, but not completely replicating. Right. And extra, I can give some extra return to see if it can outperform.
Yeah.
Okay. Active management, I don't have to say it, right? The objective is not to match any duration or something. The objective is to earn extra money on top of the benchmark. Is that okay?
Yeah.
Now okay. Let's just. Sorry.
Yeah. No, that's okay.
Another thing that they talk about, and it's very important when it comes to fixed income, and they speak a lot about liquidity. Right? So I'll give you different ideas and then you can see what comes in the exam. Right? So liquidity is a major concern. So to start with, I said the biggest problem of fixed income indexes are that, let's say they have 2,000 securities. So there are two things. One is on the run, another one is off the run. How do we define if a security is on the run or off the run? It is simple, right? You want to buy, so the Samsung usually launches this M35, M36 monster, phala phala, pata nahi kya kya wo nikalte rehte hain. So you would believe that when they come, at least I don't know now because I don't follow it much, but then 2-3 years before, when I saw it, so they used to launch another product in every 3 weeks or 4 weeks. Yeah. And then whenever they launch the new product, on the day one of the sale, it just goes immediately. Like you won't be able to buy. It just comes in for 5 minutes and it's all gone. Right? But after a few weeks, when you have a new version of the phone or new variant of the phone, then the original variant was available at a discount, but nobody was buying. Right? This is exactly what an on the run and off the run is. When a security is being issued, it becomes on the run. Everybody wants to buy that. But after a certain period of time, when you have new bonds, because every bond is different from the second bond, maybe in terms of maturity, maybe in terms of coupon payment, maybe in terms of any of the structure.
Yeah.
Then the original bond becomes off the run bond, off the run security. And obviously, since we wanted to keep our index as liquid as it can be, so when the security is on the run, we add that in the index. But and people who were replicating, and then we see a lot of, basically, if I'm going to speak about these things, I'll take 2 hours. And I can tell you which client, which country. So Chinese people coming back to us saying, "What the fuck you're doing? You just can't be removing the bond on your own." Right? And we
Yeah.
said, look, it was very illiquid bond.
Yeah.
Right? So they said no. But when it was on the run, we were replicating your index. We were benchmarking your index. So whatever
Yeah.
you had, we bought it. But now, if you are removing this bond from your index, I will have to sell this bond to be in line with your portfolio.
Mm-hmm.
And there is no market for it. Nobody's buying. And there's a huge transaction cost.
Yeah.
Right? And then there was a committee that was created, and then we discussed, and then we said, okay, to safeguard the investors thing, we will not be removing this thing. So the index kept on growing, and a lot of securities were illiquid. But we can't do it, and we can't do anything about it. If you are a benchmark, you need to follow the standards. It's not a strategy, right? So liquidity plays a major role where on the run securities are easy to get, but when they become off the run, it is difficult to buy or to sell. And it was
Yeah.
even difficult for the new clients that were trying to replicate us, even for the new clients, because they were not able to buy those securities because they were very illiquid,
Mm.
right?
Mm.
Another one is off the run versus off the run. Another one is government versus corps.
Yeah.
And in government, you have IG versus HY. And then I can also go in detail, although it is not covered, I can talk about Sukuk bonds as well, right? So we have dealt with these a lot.
What are they called?
Sukuk bonds.
Okay.
Sukuk. So basically, these are the bonds that are being issued by Malaysian, Indonesian government,
Mm.
right? Very, very illiquid bonds.
Mm-hmm.
But basically, kind of high return, right?
Mm.
So I'm saying government bonds are much more liquid, corporates are less liquid.
Yeah.
Within corporates, IGs are more liquid, HYs are less liquid. Another
Yeah.
bigger problem of HYs is since they are illiquid, you don't get a lot of trading. Stale pricing is a bigger issue.
Mm.
Okay. So basically, I'm saying I don't even have to look at the book. I can keep on speaking about these things because we see it day in day out, right? But the idea here is that liquidity is a major concern in all the bond indexes, and then we used to create a kind of a heat map
Mm.
as a model to show that which securities come under the green and which securities are red, which securities to add, which duration to add, what needs to be done. So we used to create a heat map for liquidity. It was that important. Okay. Lastly, is bonds. Mostly bonds are being traded OTC.
Yeah.
You can imagine the underlying risk that it could have. Okay. The next topic they talk about again is something that I also covered here, but they talk about pricing data. We covered this already.
Yeah.
And then they talk about portfolio construction, where they did mention that when you construct a portfolio, it is important for you to understand what is your objective, because as you know that on the run, off the run is the biggest issue. So if you want your portfolio to be liquid, then go for on the run
Mm.
government securities, right? But you can also imagine that government securities pretty much means what? Treasury
Yeah.
bills and bonds. So the yield would be very low, right? So obviously there is a trade-off. Okay? And then when you have less liquid bonds, you can imagine that the spread would be higher. Okay? And why the spread would be higher? Because obviously that's a dealer's market. Since most of the
Mm.
products are being traded OTC, it's a dealer's market. So in case you have less liquid and they are still maintaining that bond for you, so obviously they're going to
Mm.
charge higher spread. And just to tell you in a very same line, you go to a small store, right, and they'll give you a Red Bull for 125, while
Mm.
on DMart you can still get the same Red Bull for 95. And the reason is very simple, that DMart is selling multiply 10,000 piece a day, while he is selling just 2. Okay? So if there is a less demand, he is going to charge more. Between selling price and cost price, that's a spread. So
Yeah.
he's charging more spread when the liquidity is low, and the spread is low when the liquidity is high. Are we good? Clear?
Yeah.
Lastly, they also says in this topic, they also says that instead of investing into bonds, etc., some of the alternatives could also be the bond futures, and another one could be ETFs.
Right.
Now, the most important topic in this, other things are theoretical, is they would want you to calculate a few things. Okay? So
Yes.
this, when you have a bond portfolio, what are the different kind of returns that you can look at, and how would you calculate? Before looking at the question, I want to give you a few formulas and the theory around it.
Yeah.
So they say that first there are 5 components. There are 5 components.
Mm-hmm.
The first component they talk about is the yield income. Right? So they say obviously if you are receiving some coupon, so the return that you get from the coupon will be called as your yield income.
Yep.
Right? So think about this. How do we calculate our return? अगर हम बोलते हैं कि मुझे 10,000 का रेंट आ रहा है,
Coupon divided by the price you bought it for would be the yield.
correct. So 10,000 का rent आ रहा है, and I invested a CR. So I do a
Yep.
10K on 1 CR.
Yep.
So can I say that my yield income is being given by the coupon, annual coupon actually, divided by the current bond price.
Yep.
The second that they talk about is they say it's a roll down return. One second, let me see if it is roll down return. What is a roll down return?
If you just hold the bond till maturity.
If you hold the bond to maturity, and the biggest assumption in this is that the yield curve doesn't change.
Mm-hmm.
Because if the yield curve changes, then the impact will be two-sided, right? So I believe that a roll down return in my simple language is profit percentage.
Profit
And
percentage.
you rightly mentioned that if you're holding the bond till maturity, right? So can I say that my profit percentage would be, how do we call that, selling price minus cost price by cost price into 100?
Yeah.
It is as good as my final value minus initial value by
Yeah.
initial value into 100, right? So I can say that the ending price minus the beginning price divided by the beginning price.
Yeah. Ending price. Yeah.
Minus the beginning price divided by the beginning price.
Mm-hmm.
Okay. Something that we do a f by I minus 1 into 100, right?
Mm-hmm.
Which was final minus initial by initial into 100. ठीक है? So roll down return is basically that my profit percentage. तो मेरे दो तरीके से profit आ रहे हैं. Think about this. How my profits are coming from? One is from my rental. मैंने एक property खरीदी and उस
Yeah.
property पे मुझे rent आ रहा है. And then I bought for 1 CR and I sold for 2.25 CR. Another profit is from capital appreciation.
Yeah.
So this rental is my yield income and my capital appreciation is my roll down return. Is it now
Yeah.
clear?
Yeah.
And this together 1 plus 2 is called as rolling yield. ठीक है, my yield income plus my roll down return together called as rolling yield. ठीक है. Third one that they talk about is your price change due to change in yield. We understand if the price would change, then the yield would change, then the price would change, right? And then it is being defined by, you must have studied this in level 1, level 2, everywhere, which is modified duration multiply change in the yield, and to make it even more precise, half of convexity plus change in the yield square. Do we know this formula?
Makes sense.
This is even in your level 1, your level 2, and your level 3. The same formula.
Yeah.
Right? So although we say that the impact is too low of this, but it just improvises the overall result. This is like the change in the modified duration multiply change in the yield, and this is the convexity.
This is basically number 3 is when the yield curve changes. That's why we do.
So here we assume that yield curve doesn't change.
Yeah, got it.
But if the yield curve also change, then what is the change in the price is being covered by this.
Okay.
The next one, it says maybe there are some kind of defaults. Maybe. Then you have credit losses. Right? And then you can imagine that it is simple to say, then whatever what is my probability of loss? Right? Or probability of default, I should say, not probability of loss. Multiply the severity of loss. We'll talk about this. Well, you the question.
Yeah.
Right? And the last one is the gains or losses due to currency. Right? So basically, I can say it is weight multiply appreciation or depreciation of currency. Is that okay?
Weight, you said?
Weight, yeah.
Yeah, makes sense.
अगर मुझे टोटल निकालना है तो मैंने कितने रुपए लगाए थे, कितने रुपए मतलब कितना वेट मेरे पोर्टफोलियो का करेंसी में था और उस करेंसी से कितना डिप्रिसिएशन हुआ, right? So if you realize then that we are not calculating anything which is fancy.
Yeah,
at least one you can imagine that everybody does in our real life, right? When it comes to yield and roll down return, this is my capital appreciation and this is my rental. Talked about this.
Yeah.
And then on top of that, they say we assume that there is no change in the interest rate, but in the real life, the interest rates change. As the interest rate change, it is important to understand what is the impact of that interest rate change on my overall return, obviously.
Yeah.
Okay. Lastly, you said that, okay, since I've invested into bond and these are OTC markets, what if there is a loss? What if there is a loss? And how much will I be able to recover? And lastly, if I invest into some foreign portfolios, then how much my profit or loss would be in terms of currency. Okay, let's look at a question. Very important. So we can either spend 10 minutes on that, but rather that I can tell you what needs to be done in this question, and then I'll
Yeah,
teach
yeah.
you one more topic, which is the numerical portion. Rest everything else is theoretical. Okay.
Perfect. Perfect.
So I'm saying in this one you can see that the coupon rate is 3% and the current, there is a current price. Yeah, average bond price of the portfolio.
Hmm.
Okay. So this will give you your yield return. Is that okay?
Mm-hmm.
Your rental theme maybe. Second is you have the final value, you have the initial value. So final minus initial
Mm.
divided by initial into 100. So this will give my roll down return.
Yep. Yep.
Okay. Second component done. So together they will be called as yield return. What was that?
Yep.
Rolling yield. Sorry. Okay. Together they'll be called as rolling yield. So this is done. Third one they talk about is what is the price change due to change in the yield. So they say, what if uh, look at this expected average benchmark YTM change. So if the YTM decreases by
Mm.
0.54%, so this will be change. This is your change in the yield.
Yeah.
You have modified duration.
Yeah.
You have convexity.
Nice. Yeah. Yeah.
Okay?
Makes sense.
Is that okay? Last one to talk about is the credit loss. Okay? In this, they haven't given us anything in terms of the probability of default and the
Mm.
severity of loss, but I can tell you, obviously, if they're going to ask you that question, they're going to give you more data. But looking at this, I can tell you that they say that let's imagine, what was that? Oh, so fifth. Oh, so they didn't even mention that. So they say the expected price change due to change in the credit spread, right? So they
Mm.
use the word credit spread. Okay, 1 second. Acha, they change it little bit. Okay. So in my books, in the original version, they talk about the credit losses, but here they talked about change in the credit spread. So original question should always give you the probability of loss and the severity of loss. But
Yeah.
if they're looking for change in the credit spread, think about this. This change in the credit spread is very much in line with the
Yes.
change in the yield,
Correct.
right? So look at this same formula minus MD multiplied delta S, where S represents spread here, plus half
Oh. Okay.
convexity multi this. So if you look at it, it's the same formula. Instead of using delta Y, you just need to use delta S.
Hmm.
And they have given you delta S in the question. Can you see this?
Yeah.
Same formula. Instead of using delta Y, use the word delta
Yeah.
S.
Yeah.
Okay. And the lastly, they have already given you that the expected gains or losses this much.
Makes sense.
Right? So basically what you can do over here is you can look at this and calculate all the values, and that's how you can look at this. So if it is invested in 40%, and if the return is that this is 3.925, then 3.925 multiply the weight will give you 1.57 return. Is that okay?
Yeah. It's okay.
So just to summarize, they give you a coupon income that we just discussed, roll down return, final minus initial by initial, change
Yeah.
in price due to yield is this, change in price due to spread is this, and finally
Mm.
the gain and loss of the currency is this much. Okay.
Perfect.
Okay. Lastly, they talk about one more theoretical portion and then, oh, sorry, numerical portion, then everything else is easy. Okay.
Yeah.
Tell me something. Let's say you want to invest 100 rupees.
Yeah.
On this 100 rupees, you borrowed, sorry, your equity is 40 and you borrowed 60. right? At the rate, let's say 2%. Okay? On this 100 rupees, your return is 5%. So far, so good.
Yeah.
So you are investing your 100 rupees. In this 100, your 40 rupees is your own money, your equity. 60
Yeah.
rupees is that you borrowed at the rate 2%. And your overall portfolio return is 5%. So if you have to calculate your return, is it right to say that on my 40, I got 5% return?
Yes.
And on
No.
my 60, huh?
Oh yeah. Okay. Correct. Yeah.
So 5% on the 40, and
Yeah.
on 60, I actually got 5 minus 2 because 2% is something that I paid,
Yeah.
and I got 5%. Effectively, on the 60, I only got 3%. Is that correct?
Yeah.
And how much did I invest overall? Does this make sense?
Why did you do 5 minus 2?
क्योंकि 2% पे बोरो किया था, ठीक है?
हाँ.
अगर बोरो करोगे तो वो तो माइनस रिटर्न में से माइनस हो जाएगा ना?
Yeah. This makes sense.
I'm not teaching any formula. I'm not teaching any concept. I'm just saying in the real
Yeah.
world, how do we do? If I'm going to
Yeah.
get 12% return, and if I have to pay somebody 6%, so your effective return will only be 6%, right?
Yeah.
So I'm saying, but this is your own equity, this is your own money. So the 5% is on 40 plus on the borrowed money, the return is only the extra return that you got. And I hope you understand that why do we divide by 40 and not by 100 is because we only divide by the amount that you invested. Abhi, you are also compromising with this 2%, right? So why would you use 100? You're only
Correct.
going to look at the returns from your equity perspective. Is that clear?
Yeah.
So can I say that this is, in a way, this is my value of equity?
Value of?
Equity.
Yeah.
This is my value of bond.
Yeah.
This is my return on investment.
Yep.
So this will also be my return on investment. This is my return on the borrowing. I'm calling it return ultimately because cost bolo, return bolo, kuch bolo, minus to karna hai. So can I say that my RP is being given by VE RI plus VB RI minus RB upon VE?
Yes.
So can I say this will be equal to VE by VE RI plus VB by VE RI minus RB?
Yes.
So can I say that my RP is being given by RI plus VB upon VE RI minus RB?
Yeah.
Trust me, Gaurav, I have taught so many batches and nobody understands this कि कहाँ से और कैसे करना है. जबकि they look at it as a formula and say it's a very difficult formula. But when I explain it this way and I say this is what you do in real life, they say it actually makes sense.
Yeah.
Okay. So a lot of times you really don't have to solve a question using the formula, but you can always look at कि मैंने इतने रुपए उधार लिए, इतनी मैंने बोरिंग करी, तो ये रिटर्न मैंने वहां दे दिया, ये रिटर्न यहाँ से आया, और ये मेरा टोटल, तो मैं कैसे करता इन जनरल. ठीक है. And a lot of times you lead to the right answer. ठीक है. Knowing the formula is always good, but then deriving it this way will ensure that even if you get confused somewhere, you will be able to get the right answer through doing it manually. ठीक है. I think apart from that, they talk about that there are different ways to, and they say now that you have a leverage of 60, How can you get this 60? Maybe you can go for repurchase agreements. Maybe you can go for futures. Maybe you can go for swaps. Maybe you can go for structured finance products.
Mm-hmm.
Okay, but they are all theoretical. And then they also talk about later that there's discrimination between tax versus tax exempt
Mm-hmm.
products, right? Something that we already discussed before somewhere else, right? So अगर heavily taxed हो तो फिर tax exempt में जाना है and low
Huh.
taxable है तो taxable में जाना है, ठीक है? And then the last they talk about liability driven, but for whatever that I've explained you before, I think
Yeah.
it will not be difficult.
Yeah.
Okay. So I think even in fixed income, I think I covered more than 50% overall.
Yeah. No worries.
And
Yeah, that's perfect.
sorry.
No, this is perfect. This is good
Yeah.
enough.
So I'm saying when you go through that, you will not find fixed income difficult anymore. That's just one topic in fixed income, and that's
Yeah.
fairly easy as long as you understand these two numericals. Everything else is just theoretical.
Yeah.
And the theory that I've explained you is useful, so you can get questions around liquidity, etc. on that.
Mm.
Okay. All right. So I think with that we covered the overall
Thank you so
course,
much.
right? I just want to take a genuine feedback. Or did you find this course helpful?
No, no, super, super helpful. I think very clear in terms of the concept, very easy to understand. Um, Feeling less stressed also now.
Okay. Okay. Great. Okay.
So
So
thank
I'm
you so
saying
much.
no worries, no worries at all. I'm saying all the best for your exam.
Thank you.
Do let Pankaj know how did it go in
Yeah.
general, right? Maybe
Yeah.
we can communicate. We can again get in touch with each other. Maybe Pankaj को मैं बोल के we'll have a talk. ठीक है?
Perfect.
Exam जब देकर आओ तो at least give me a call.
I'll do
So
that.
that I would also know, right? जो मैंने पढ़ाया है, जो चीजें हैं, वो कितनी useful रही एग्जाम में,
Yeah.
concepts कैसे आए, ठीक है? So that also gives me motivation. And then if you clear the exam, let's just go for a coffee.
Yeah. Let's do that. Let's do.
Right. All right then. Cool. I'll speak to you later.
Yeah. Thank you so much. Thanks a lot.
Have a good one.